next speaker is Dave Manning, Global Head of Hybrid at Juwi Renewable Energies Pty Limited. Dave has 25 years international experience in power solutions for mines and remote energy customers. He was also previously involved in Sandfire Resources' DeGrussa hybrid project here in WA, which we heard about on day one of the conference from Carl Simic, as General Manager for the thermal power station owner, from initial contract negotiation through to project completion. Based in Perth, Dave is responsible for overseeing the installation and operation of hybrid installations worldwide, with Africa and Australia being the prime focus regions. Dave.
Good afternoon and good morning to our partners and friends in Africa. And as echoed by the other panellists, thank you to the organisers for putting on such a comprehensive schedule over the last few days during some rather challenging times. It's certainly been an interesting year for both the mining and the energy sectors, and Africa has certainly seen its fair share of turbulence over the last couple of years. That being said, there's also been some significant projects undertaken and some fantastic results on the back of some staggering commodity prices. Copper prices pushing through $3 a pound and zinc performing just as well has certainly put a bit of a smile on Errolsdale over there at Orion. And of course, nickel climbing back over 15,000 a tonne. Certainly the boys at IGO and Peter also very happy. Platinum looking fairly stable and sitting at around $872 an ounce. Natasha over there at Anglo, pretty darn happy. And of course, Western Australia, we know this quite well. Gold, it's been a cracking year. The boys over at IM Gold, also very happy. Of course, not everyone's happy at the moment, but sorry. Too soon? Too soon? I thought I'd take a moment today to discuss energy and fuel costs. In many mining operations, energy can make up almost 40% of the operational costs, and the recent volatility has certainly had a significant impact on operations. In the energy sector, back in April of this year, we saw the US oil benchmark fall by $50 a barrel, and at one point the price dropped to actually negative $30. It's the first time in history we've ever seen oil drop into the negatives, predominantly a quirk of the market, but it does certainly underscore the industry's disarray and what coronavirus is doing to the industry. After rebounding from the April lows, oil price averaged around 40% higher in the third quarter of 2020, but still significantly lower than the 2019 average. Outside of China, demand remains lower than pre-COVID levels and is expected to only recover gradually over the rest of this year. Looking at gas and coal, after a sharp fall in the first half of 2020, natural gas prices recovered in the third quarter of this year, particularly in the European markets. And despite some disruption from COVID-19, of course, LNG continues to increase in importance and accounted for roughly half of the natural gas traded in 2019. In contrast to coal, of course, coal has reached all-time lows. Demand for coal fell sharply in 20, and COVID-19 pandemic exacerbated an existing transition towards natural gas and renewables in electricity and energy generation. What is very interesting in 2020, it was the first year when renewables overtook coal energy in the US, and we expect to see that in a little bit more over the coming years. Coal will continue to be impacted by the shift towards renewables and natural gas in generation, although it is expected that natural gas prices next year will increase coal's relative competitiveness. The IEA forecasts that additions of renewable energy capacity will actually decline by 13% in 2020 compared to 2019. This will be the first downward trend that we've seen in renewables since the year 2000. And in fact, it's a 20% downward revision compared to the previous forecast because of the forecast was 2020 was forecast to be a record year. This update is purely reflected by the construction activity, supply chain disruptions through lockdown measures, social distancing, and the emerging financial challenges. Focusing on shortly for South Africa, we see that whilst natural gas and renewables are growing slowly, coal makes up the lion's share of energy production in South Africa. Moving on to the Eskom issue, and many of you are certainly dialing in and in this room are familiar with the issues that we're facing with Eskom in South Africa. According to Bloomberg Economics, the single biggest risk to South Africa's economic outlook, and consequently the mining industry, remains the availability of electricity. It's an issue that continues to hold back productivity and investment growth. Currently, South Africa's economic growth is lower than 1%, and unless the Eskom issue is resolved, it'll continue to be an issue. Eskom's debt currently sitting at around 488 billion rand at the end of March 2020, up by about 48 billion compared to March 2019. And it's expected when the next quarterly results are released, it's going to be closer to 500 billion rand debt. The load shedding, again, many of you will be familiar with the load shedding issues in South Africa. It's experienced the worst load shedding this year, with the total gigawatt hour shed surpassing the 2019 record in August. Cumulative load shedding for 2020 is already 23% worse than 2019. And the new Eskom CEO, Andre de Ruyter, has warned that South Africa should expect increased load shedding over the next 18 months, as Eskom will no longer defer required maintenance and will aggressively move to prevent the deterioration of its power plants. That being said, that's the doom and gloom. There is lots of good news as well, and we certainly welcome the direction that Eskom's taking of late, including the unbundling of its activities into 3 separate entities in generation, transmission and distribution. And Eskom plan is moving ahead with the recently published 2030 Transmission Development Plan, providing an additional some 6,000 kilometres of transmission lines and transformer upgrades to the magnitude of 30 gigawatts. The quick fix, there is little doubt that the most efficient immediate intermediate step is using Section 34 of the Electricity Regulations Act, in which the Minister for Minerals and Resources and Energy can issue a determination that allows qualifying municipalities to bypass Eskom and procure electricity directly from the IPPs. This will allow the IPPs with rapid deployment and low-cost solutions, such as renewables, to improve the security of supply and provide the mining industry with energy at a cost equal to or less than Eskom, but with 99.8% reliability. We're also delighted to see that there's a clear acknowledgement from Eskom's CEO, as well as senior decision makers, that renewables are the lowest cost form of energy available today and in the future. And that, in effect, there is no financial cost to Eskom to procure energy from the IPPs, as their project's full life cycle cost and risk is fully factored into the tariff. It does seem clear that as the energy sector's enabling environment is improving and political barriers are being removed, that there is little doubt that the country is positioning itself to be a major ongoing uptaker of renewables and its associated direct investments. This is a huge win for not only South Africa, but the economy and the environment. So the big question is what's changed? Why is renewable energy now all of a sudden so much cheaper, when only a few years ago, when we did the DeGrussa project, it required a significant amount of government funding? If we look at the answer is really in the raw material components. So looking at PV prices, they're now down around 94%, and as recently as 2008, we were paying over $4 a watt for a solar module. Now, today's prices, they're dropped down to less than 25 cents a watt. Wind turbine prices have dropped by 37%, and most importantly, battery prices have dropped by a staggering 85% in the last 10 years. That factor alone is what's allowing us to push the renewable energy fractions of projects up and start to increase the reliability of off-grid supply. Benefits of going renewable in mining. There's many benefits, and if we look at the cost reductions, it's now not only proven, but it's significant. Carbon dioxide emissions are heavily reduced, security of supply is brought back in-house, and the reliability is significantly higher than that of on-grid or pure thermal energy solutions. Power quality is improved. The latest battery and inverter technology is allowing us to incorporate grid smoothing and reactive power management that we weren't able to do previously. New large-scale PV wind turbine facilities are offering local communities an opportunity to not only get involved in the construction phase, but also move on to long-term maintenance and operations. And then, of course, renewables is providing mining companies with an opportunity to improve their social licence to operate, with many investors now demanding a greener solution. All of these factors, of course, are leading to a massive spike in the number of renewable energy projects being built, and last year over 3,500 megawatts of renewable energy projects were announced worldwide. Companies like Goldfields are leading the way with the recent commissioning of the Agni project up here in WA, generating almost 60% of its energy from solar and wind. Initially, that project was viewed as a really good project to mirror the successes we had at DeGrussa, and install a low to medium penetration solution, around about 20%. But that project is currently delivering over $5 million worth of fuel savings for that project alone. And Goldfields took that, pushed it out a little bit further, worked with our design teams and came up with a 60% solution. Goldfields, of course, continue to lead the way with the recent completion of their Granny Smith site up here in Western Australia as well, and now have their sights firmly fixed on larger solutions for projects like their Deep South project in South Africa, a 40 megawatt project. Various other mining companies in Africa are also planning to build solar facilities, including a 200 megawatt facility under development with Sibanye-Stillwater, a 75 megawatt facility planned by Anglo, and a 200 megawatt plant by Vendata. Orion Minerals, of course, who are reopening their Prieska mine in Northern Cape, are in the process of establishing their own renewable plant that can deliver up to 38 megawatts of power. Further afield, B2 Gold is looking at establishing their 30 megawatt hybrid plant at Fekola. Resolute Mining, of course, well underway with their 40 megawatt solution, also in Mali. Centamin out of Egypt have commenced early works on their 36 megawatt facility at Sukari, and that facility alone is due to save around $18 to $20 million of diesel per year. So, in summary, hybrid energy can provide a fast, reliable and cost-effective solution. In some cases, it can be delivered in under 9 months. Diesel and gas power solutions will continue to underpin renewable energy solutions. However, solar and wind will significantly reduce the volatility and price uncertainty. Companies such as Juwi now have the knowledge, the experience and the capability to provide these world-class solutions. And that's it. That's the end of it. Thanks for your time.